Dr. Joshua Bamfo is an economist. He's also a partner and head of transfer pricing services at Anderson Tax Nigeria. Is live here in the studios. Good morning. It's good to have you.
Good morning. Thanks for having me.
Thank you very much. When new legislations like this come into effect, and tax is a very, sometimes very difficult to unpack. Exactly. When it comes to understanding what a taxman wants and what individuals or companies should do. In this particular instance is the multinationals. When Nigerians hear about multinationals, well, they think those guys are always cheating on the government. So I'm going to go straight to that question. Do multinationals shortchange Nigeria in terms of tax payments?
I think we need to look at it holistically, all right? Clearly, multinationals bring a lot of value to the economy in terms of job creation, in terms of providing valuable services and goods to the people of Nigeria. So you cannot take it out of the equation when you're talking about value contribution. At the same time, multinationals are also the usual target when it comes to collecting revenue because they are so visible. They are in the formal sector. So we cannot also dispute the fact that they make their significant contributions to the economy in terms of tax payments.
So it's natural for revenue agencies, whether customs, FIRS, whatever, to go after them or keep a permanent eye on them. Even social advocacy groups tend to focus more on the multinationals, whether they're in oil, in construction, consumer goods, whatever it is.
Exactly. However, there's also the notion, and there's some partial truth to the fact that every business would want to have a lower effective tax rate. In other words, if within the confines of the law, I can reduce the amount of taxes I pay, why wouldn't I take advantage of it?
That's not illegal.
That's not illegal. That's what has been termed tax avoidance, right? Sometimes there could be loopholes in a regulation or a law that they can take advantage of. Now, the issue has moved from legality to morality, all right? Because some of the international tax laws weren't up to date, especially if you take the digital economy, e-commerce. There weren't guidance that was up to date as to who has the right to tax them when there are activities. For example, if you purchase a product from Amazon, all right, you are in Nigeria, but then the product could be shipped from, let's say, Europe, but Amazon is headquartered in the US. So who has the taxing rights? And we needed some guidance. So from that perspective, some people might argue that they might not be paying enough. But as to whether they are making valuable contribution, I'm of the view that they make significant contribution to the
economy. Why is it that Nigeria's federal inland revenues brought out this new regulation? Why? What is the imperative of this new one?
All right. It's important for us to have an understanding of the background of this regulation because it's not an initiative being made by Nigeria on its own. It's actually an international global initiative that Nigeria is implementing. All right. This initiative actually started as a fallout of the financial crisis that occurred about a decade ago, starting from the US. What happened is it led to a global recession. So almost every advanced economy then needed to implement some expansion fiscal policy. You cannot implement an expansion fiscal policy without tax revenue. So they had to look inward and see whether, look, are we protecting our tax base? And they recognized that given the current international tax laws, there was an incentive for multinational enterprises to shift profit from high corporate tax jurisdictions to lower ones, right? So they need to come up with some action points to mitigate that form of schemes, which then shifts those profits. Now, one of such, which is called Action 13 of this base erosion profit shifting action point, is this country-by-country reporting. And a lot of countries are already implementing it. Nigeria is just implementing what others are doing.
We've seen those cases. So where do we find the loopholes in the Nigerian system in which when some advocacy groups see hundreds of billions of dollars in unpaid taxes or revenue, whether via the gas business or the entire hydrocarbon sector? I'm sure the folks in industrial and consumer goods get a bit of a less attention. Why is it peculiar to the extractive industry?
All right. In terms of its relation to this particular regulation, you need to be mindful of the concept called transfer pricing. In fact, there's an existing regulation for transfer pricing. And basically what transfer pricing talks about is the transactions that occur between multinational group entities. And there's an incentive, that's what tax administrators think, that they can misprice these prices so that you shift profit from one jurisdiction to the other, right? So there's a need for us to have more robust guidance, and there should be more transparency about the activities so that tax administrators can actually have an effective and efficient way of auditing such firms to ensure that you don't actually misprice those related party transactions to shift profits from a country like Nigeria, where corporate tax rate is as high as 32%, to other countries where they have corporate tax rate in single digits or even zero. You understand me? So that is part of the reason why there was a need for this particular regulation, because what this regulation does is multinational enterprises that meet a particular threshold in terms of their consolidated global revenue should then report, some information about their financial results, the taxes paid, and the economic activities in countries that they have footprints. So if FIS gets access to such an information, they can then actually look at that particular multinational enterprise and say, okay, you have less economic activities in this particular jurisdiction, so how come there's so much profit there? Is it because the corporate tax rate is zero or is lesser than Nigeria? In which case, they can then audit you and make sure they make the necessary adjustments.
So open the books. For a typical hydrocarbon company, and I don't want to name names here, okay, operating in 5, 10, 15 countries around the world, but you've got a unit in Nigeria here, and you're doing XY barrels of oil and gas here. So this places the books before the IFRS. Say, look, bring your books. Let us see country by country basis. And show me if you're making XYZ amount in Nigeria, but you're paying X only as tax. And the other jurisdiction, you're making, okay.